I was actually in the US last week during the elections, and my impression was that I was actually in the US several times this year, and I, both before Harris replaced Biden and after that, and what I kept hearing is that I actually expected Trump to win, so I wasn't surprised, and but I was a bit surprised by the margin he got.
Mm.
But most importantly, I mean, it seems to me like both a couple of days before the election, during the election, after the election, everyone that I met, I talked to, was very calm and cool about it. Of course, some people were happy, some unhappy with the result, but it seems to me that people are making much less deal of it than media. Media tried to paint it as a matter of life and death almost, but people in the US are actually quite cool. Of course, because the market's starting rising, immediately after the election, then the people that I, moving around with, were of course happy because things were going up. But I think the business environment would be more friendly with Trump in general. Some sectors will definitely benefit from it. I think that, you could see the big move up in financials, because I think the financials, especially bank, would have a more reasonable, regulatory environment, etc. Some domestic businesses that are oriented domestically will also benefit. I think it's difficult to say what kind of, trade barriers and tariffs he would come up with. You never know. But I would generally expect more higher inflation over the next several years, because the U.S. policy, fiscal policy is so expansionary that it would keep being so, that it would really drive inflation higher. And you can see also that the interest rates have been ticking up, especially the long bonds. I mean, the 10 years now, 440 or so, and the dollar is very strong, which I think is also a kind of reflection of the interest rate differential. So, but in general, I think the US is having a couple of huge advantages over the rest of the world right now. I mean, the US benefited extremely over the last 15 years from the development of shale oil production, because it helped the United States to double oil production, and that really changed the game. Not only it made them self-sufficient in oil and gas, improve the trade balance, but also it lowers the cost of energy in the United States, especially cost of gas. And this is increasingly bigger and bigger competitive advantage, geopolitically, cheaper energy. If you compare it to places like Europe, that has the highest energy probably in the world, and European companies are becoming very, very uncompetitive because of that. So that's one. And the second thing is that US is right now going through a huge AI boom, but investment AI boom, because the largest companies are spending hundreds of billions of dollars in building the AI capabilities and computing capabilities and data centers, etc. And so both of these sectors, the production of oil and gas and the AI, create a lot of investments, which is great stimulus for the economy, and it brings a lot of business to suppliers and industries, etc. And you don't have any of these in other parts of the world, So I think that gives the US a very big competitive advantage. And but things are changing. You see that when companies like Meta and Alphabet became listed, 15 years ago, I don't know, something like that, they were really benefiting from the fact that they came with the product to internet, which is already there, right? Someone else built the infrastructure, the cables, the internet, etc., and they just put their own applications on the existing infrastructure. So it required very few capex, and they could do very capital intensive businesses, and it was very good. But now their businesses have changed dramatically, because they now, if they want to graduate further into this AI level of business, they have to be spending hundreds and hundreds of billions of dollars for capex. And so when you look at the data, you can see that the earnings are rising, but the capex spending is rising much faster. And also you can see that if you look at the revenues per capital per dollar invested are actually declining. So the business is now not anymore asset light. It's actually asset heavy, and all this infrastructure, when it's in place, would be also very expensive to maintain, especially consumes a lot of energy. And some of these things also depreciate very fast. If you build a data center, it depreciates maybe over 5 years or so. It's a lot of these computers and chips and software. So these businesses are changing, but their cash flow is squeezed already by capex, and the earnings will be squeezed later on by increasing opex and increasing depreciation. But it drives the whole economy forward, because it's really hundreds of billions of real investments, money, spent on investments are driving. So we looked at how to benefit from that, and we saw that right now the best way to benefit from that is to buy the picks and shovels, basically the companies that help them build the infrastructure. So one of them would be our big investment in Brookfield Corporation, which one of their key businesses is investments or financing investments in the infrastructure segment, and this will probably become over time their biggest piece of business. And if you look just how much money has to be spent on building these AI capabilities and data centers and energy supplies, plus on top of that, you have this all energy transformation moving from fossil fuels, to renewables, and at the same time we have increased in demand for energy. It requires, hundreds of billions of dollars, and Brookfield is perfectly capable of supplying that. So that's where we're trying to, put some money recently. And more recently, they have been. We're now in the middle of the earnings season, which is always interesting because you not only get new additional pieces of information about how the companies are doing, but also that brings increased volatility among stocks because things you have some data and information that is moving the market. So last week there was a very interesting move in the shares of Burford Capital, which is one of our large holdings. It really shows how little many investors know about the companies that they invest in. Because what happened is that the U.S. government has asked the judge Presca, who is judging the Burford versus Argentina case about the expropriation of YPF shares, to wait till the 6th of November, because the government wanted to file something about whether some of the sovereign assets in the place of that country can be asked by the court to be moved outside the country as a collateral to satisfy demand, etc. And everyone expected that the government position would be negative. It was expected by knowledgeable investors, and it was also expected by Burford. And most of all, it's almost inconsequential. It has no impact on the actual case. So the government did file, was expected, but then next morning, Financial Times headline was U.S. government sides with Argentina, regarding the YPF case. So complete nonsense. And people that know nothing about Burford's business try to panic. So the stock actually opened 25% down. And I was in the US at the time, I couldn't sleep well, so I was in the gym at 4 a.m. Riding the bike, and I just wanted to check what's the market doing in Europe. And I opened mobile phone. Burford is down 25%. That makes no sense. So I stopped exercising and I ran up to the hotel room. I said, I'm going to buy some more shares. But by the time I started up the computer, basically the stock was only down maybe 9% or so. So I kind of missed the move. Wow. And the stock actually moved and the day in the green, up.
Yep.
So it's like totally crazy. So we're living in a market where most of the people actually don't really know almost anything about the companies they're buying. I find it totally fascinating, but at the same time, absolutely great, because when you talk to someone, and I don't mean professional investors, but when you talk to semi-professional or hobby investors or even some professional investors, and you talk about some companies, you realize very quickly that they haven't even looked at the financials. I mean, right? And that when you start talking about valuations, you see that they have no concept or valuation which would be based on real data, right? So I find it fascinating, because how can you invest in something without actually knowing the facts and data, and having no idea about the valuation, right? But this is the world where we live in. The people basically invest based on bits and pieces of influence from social media and etc. And they're very short and oriented, which I find excellent, because the less people try to actually value stock, and the less people actually know about companies, the less competitive environment there is for investments, and I think this is an excellent environment for investing. Because I think the market is very expensive. Because when you look at if you look at the US market, I always look at the S&P Global data. S&P Global is a company that puts the S&P 500 index together, right? So it's like an official arbiter of data. And when you look at the as-reported earnings, which is the GAAP reported earnings of companies, not operating earnings or adjusted EBITDA, but operating GAAP earnings, then at the end of September, which is the last closed quarter, it was 202. So with the index at 6,000, you're now talking about 30 times earnings, for index, which is very, very high. And people say, well, the earnings are growing very fast. But then again, if you check the reality, it's not the case, because the earnings of the index over the last 10 years went up by 6.8% annually, and over the last 20 years, only 6.6% annually. So
decent.
Because yes, in some years they're growing much faster, but then you have recessions when they go down a lot. So if you put it all together, you're paying 30 times earnings for less than 7% annualized growth. So it's very expensive. If it was an individual stock, I wouldn't even touch it. But people are quite happy to buy index, because it just worked very well in the last several years. But I don't think 10 years from now, if you look back to today, I don't think that you would say, oh, that was a fantastic time to buy the index. I think you'd probably say it was actually not a very good time to buy the index, but you will very likely say there were so many individual stocks outside the index that were incredibly cheap. How could I miss them?
Yep.
That's what people should be doing. And forget the indices. I think they're so expensive that you shouldn't buy them. But because people only buy indices, and a handful of biggest stocks, very many stocks are being left untouched at valuations which are extremely attractive. You can buy really good, fast-growing companies at 4 or 5 times earnings, which I find completely, amazing.
Yeah, this is a perfect environment for stock pickers.
Yeah, absolutely. The best that I remember in 30 years of my career.
Oh yeah, wow. This is a perfect environment for hunting and just turning many rocks. For the audience that is watching this YouTube channel, all of them are stock pickers. Do you have any advice to be a sophisticated investor in this crazy environment? A specific advice?
Well, I don't know if I can shorten it to 1 or 2 sentences, but basically, you should always view every investment as an activity where you're trying to buy something for less than it is worth, right? And that doesn't only apply for stocks; it applies for any investment. So you know what the price of everything is, so you have to also come up with your estimates of value. So you should try to learn about companies, learn about the businesses. Try to learn the basic valuation approaches, and then you should look for the cases where the gap between price and value is really attractive, and you should basically think independently. And if you come to conclusion which is completely different from the majority, then just do it, because the most valuable ideas are where you have an idea where you are right and you are in minority, right?
Oh yeah.
If you have an idea where you're right, but everyone else thinks the same, this is fine, of course, but you will not make much money because everyone's already thinking the same. So it should be probably reflected already in the price. But if you are right, and you will find out later whether you're right or not. But if you're right about something, and you're in small minority, then most likely this is a very attractive investment opportunity, because the majority of people that have different opinion would also be reflected in low price of investment, or it could be that something is extremely expensive and that you're also in minority and you don't touch it.
Yeah, as we say, it's better to be early on trends before everybody sees the opportunity. Well,
Yeah, the environment, the character of the market, which is now being driven completely by passive investors, is very favorable for stock picking, but it also requires patience, right? Because um, the process of price discovery is working much slower than usual, because
yep.
much less people are trying to discover undervalued stocks. So you should have a patience, but if you are patient, then I think this is an excellent opportunity for time arbitrage.
Yeah. And what about micro caps on this YouTube channel? A lot of the comments are about micro caps because of this hunting ground. Nobody wants to touch the stock. The big hedge funds can't touch these stocks. It would not move the needle for them.
Mm.
Do you think you can have some good opportunity in micro caps in the US, in Canada, or even in Europe?
Yes, in theory, of course, because there's much less competition and analyst coverage in very small stocks, but the businesses have very large percentage of failure,
Yeah.
or non-performance. So there are certainly large risks associated with that. But having said that, our largest percentage gains were achieved in companies with small capitalization,
Yeah.
right? But also, um, we have seen many cases where things trade at a net cash, etc. But things never work out, so you should be very careful. But if you think you can find something there, and it's based on careful research, it's why not. But usually many of these small stocks, is very difficult to find enough information about them. I mean, not only because the analyst coverage is low or non-existent, but also many of these companies publish very little data about themselves, which is usually an obstacle.
Yeah. Family owned businesses that
Yeah.
don't really care about minority shareholders. Yeah, for some of the microcaps, a lot of things can go wrong, like bad guidance or bad capital allocation, or they do some stupid stuff, or there is a buyout. A lot of things can go wrong for this one.
Yeah. But it also happens, this can also apply for large companies. For example, a good example of that is the Bolloré-Odette case in
Yep.
France, where you can argue that the discount in both in Bolloré and Odette shares to the actual real NAV of the business is very high, 50 or 60%, and that's probably true. But these companies produce very little data about what they do. I mean, they produce annual report, usually in middle of the year, right, which is quite late. It comes in French language first, and then in English later. It contains a lot of formal, required data, but there's very little said about the business, the management intentions, the expected strategies. So you would only have to, and they only report twice a year, so you would have to really base your investment approach on faith in the management. And some people are happy with that, but I prefer to have actually more data,
Yeah.
rather than faith. So sometimes it also applies for larger companies.
Yeah, that's true. Before we move on, I'd like to come back to what you just said about the capex increasing for the Magnificent Seven, the big tech. You said that, yeah, this was a change in business model. Now they need to reinvest massively in capex, etc. Is it the first time we have this shift in an industry from low capex to high capex? Is it the first time, or not? Maybe in the 80s, something similar happened.
I think in this magnitude, it is the first time, because if you look back 20 years, back, we didn't really have asset-light companies, right? I mean, there were some yeah, I mean, you could have Oracle, or you could have SAP, and advisory businesses, etc. But you really didn't have large companies that require very little tangible assets. I mean, these companies only started appearing during last maybe 20 years or so, okay, and they have become really large. And now their business is changing also unprecedentedly fast. So I think this is the first time that we had such a move.
Yeah.
And I think people still don't appreciate that very much, because when you look at stocks like Alphabet, it trades at 2% free cash flow yield, which is very, very little. Because you should also deduct, when you look at the cash flow, you should deduct the stock-based compensation, which is usually shown in the operating cash flow, but it is actually financing cash flow because you're selling stock, to pay investors. So you should deduct that, and then when you look at the buybacks, so they also have to spend much more just to immunize the SBC, because they pay much more on the market for the stock, etc., etc., etc. So when you figure out actually what the real free cash flow actually is, it's actually quite small. It's really only 2%. So 2% free cash flow yield is not very exciting. And
Yeah.
the same goes for Microsoft. It also has quite small free cash flow yield, and Meta and Amazon. Especially Amazon. Yeah.
Yeah, the buyback that everybody is excited about is just to offset the dilution. I guess what gets people is excited also is the cloud business picking up, or AWS, pure profits to the bottom line. I suppose people invest in the future, thinking that it will be like this forever for the next 10 years.
Yeah, but because I should remember that all of these large companies are competing with each other, right? I mean, Amazon was first, so they had a first mover advantage. But there's now a number of providers, and they're all trying to build the business fast. So, they're spending a lot of money to build it, and eventually it will eat a lot of their margins. I mean, there's a theory called capital cycle theory that says you should not really invest in industries where there's too much capital being invested, because if you have an industry where companies spend a lot of money, then there's a very large chance that they will overspend, and this oversupply of capital would decrease the returns of capital. And on the contrary, you should invest in companies or industries from which capital is actually, leaving. Because if there's not enough capital in those industries, then more likely the returns on capital would be higher. Okay, so maybe investors should figure out, which are which.
Wow, tricky exercise, And what you're saying about cannibalizing each other, this is, I think, what happened with Chinese cloud, with Alibaba doing discounts for their cloud so that they don't get eaten their market share from Tencent cloud.
I remember very well in the 90s, when there was a big boom of internet, everyone expected huge growth of internet traffic. Okay, so companies were, killing each other, who can build more optic fiber capacities. They were laying cables all around the world many times over, etc., 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 and trying to, build for the upcoming business. But then it turned out that they had built so much of it that most of them went bankrupt. Global Crossing and WorldCom and I don't know what else. So, and actually, these cables are still in place today, and they're still not fully used today. So so now you transfer data by air, etc. But these over investments can happen even in companies that are supposedly expected to be smart. And then Buffett calls it the corporate imperative, which means that if one company in an industry starts doing something, everyone else follows, because they think, well, I don't know if this is a good idea or not, but if they do that, maybe they figure it out, and I should probably do that as well. I don't want to be left out. Sometimes it is a good idea, but very often they all end up wasting money. I'm not saying that was the case with optic cables. I'm not saying that building huge AI capacities would be the same, but there's a non-zero chance that it could be that they could overspend, and the returns on capital could be actually quite disappointing.
By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video.
I was comparing this to the cloud trend and investments in cloud, but the dimension is not at all the same. We are talking about much bigger amounts now.
Yeah, we're talking hundreds of billions being invested every year. Yeah.
That's massive. That's massive. And it will have an effect for 2025, 26, 27, all the big capex and reduction of free cash flow. Yeah. Is the best hedge against, I mean, there will be more inflation with tariffs or whatever you want with the expansionary era that we have. There will be investment in capex and data centers, etc. Isn't the best hedge Lens in Texas? I remember the first analysis I did for you was Texas Pacific Land, TPL. You have another company, Landbridge. We discussed it a few weeks ago. Now they are trading high, but if you speak like a multi-year process investment, if you think for 10 years, I mean, if you own land in Texas, you will build data centers in Texas, lands, cheap energy, no capital requirement. Is it the best hedge against all this uncertainty?
Well, I don't know if it's the best hedge, but it could be a good investment opportunity, because if you build data centers, compute centers, etc., you need a relatively, I would say, good business environment. And states like Texas have probably better investment environment than California or New York, whatever. You need land, so you need a lot of space, because it takes quite a lot of space, so you need land. You need energy, and most of these data centers will be powered by gas, I think. So that's also Texas, and you also need water, a lot of water.
Yep.
So, and if I remember, TPL also supplies water, right? They have or they're selling water rights. So yeah, this could be a boost to their business. That's quite possible.
Yeah, with minimal capex.
Yeah.
Or if you want to have the picks and shovels for this big capex trend, a lot of people mentioned Nvidia.
And there's probably a natural inflation hedge in that business, because those royalties for oil and gas production and for water are based on the price of the commodities and on general inflation trend. So that should be also a reasonable. And they have very little capex. TPL has very little capex, basically.
Almost zero.
Royalty company. Well, it changed the business a little. They used to be a trust. Now they're a corporation, and it changed a little. But yeah, it is asset-light business, absolutely.
I mean, if the Trump administration follows and what they're saying about drill, baby, drill, you will have some opportunity in these royalty businesses. So it seems like you have a hedge against. This is maybe not the best investment because of valuation right now, but definitely some good pick right now. And apart from this, apart from the AI boom in this market for stock pickers, what are the stocks that you find exciting at the moment? I know you are big on Alimentation Couche-Tard. There is now an acquisition or a Japanese company that is not going well. They don't want to be acquired. Can you elaborate on this for the viewers?
Yes, I mean, Couche-Tard is one of our largest positions. It's been probably the best business story in Canada over the last 30 or 40 years. And it's one of very few companies that can grow successfully or have been growing successfully via acquisitions. I think more than 3/4 of the business came by acquisitions, and their acquisitions are usually very good. They don't overpay. They know how to integrate the business. They don't take too much debt, and they can really do them very well. Well, now they are trying to buy 7-Eleven, Japanese firm, which is almost the similar size as themselves. And I mean, they haven't officially said that, but they're talking about something like $39 billion, which would be the biggest takeover in Japan, ever. And but they of course think it's a good opportunity. Otherwise, they wouldn't do that. Because I believe that they honestly believe so, because Alimentation Couche-Tard is still controlled by the founders with a very large ownership stake, and I think they think and act as owners. But it is very complicated. First of all, the size of it makes it risky. Okay, they would have to issue some shares, take a lot of debt, and also they could probably go back to current leverage within 3 years. It's still a lot of risk. It's a business that it's based in different country, and Japan has a very different culture from where they live or we live. And the management of 7-Eleven is not very friendly,
No.
not open to discussion. So they refuse to meet, they refuse to talk, etc. And now they came up with another buyer. The son of the founder of 7-Eleven is supposedly ready to bid for the company as well, and is ready to pay a higher price. Okay, so now I don't know whether this is just white knight, trying to either force Couche-Tard to pay more or try to turn them away. But I'm really, really praying that Couche-Tard just walks away from it. It's too large and too risky, and I know that for them this would be really transformational deal, but I don't like transformational deals.
Yep.
I think they should go back to growing the business in much smaller steps, acquisitions at size of below 10 billion. I think there's still a number of them they could do in US and Europe and Latin America, where they're not present at all. And in the meantime, where there are none available, they should continue buying their own stock. I mean, over the last 5 years or so, they bought 20% of its own stock, and they should just continue doing that. So and because the stock moved up yesterday nicely, I mean, when it became known like 2 months ago that they're talking to 7-Eleven, the stock price started going down because the market is not very enthusiastic about large acquisitions, rightly. But yesterday, when the Wall Street Journal reported that there might be another buyer for 7-Eleven, people maybe now think that the probability of them walking away from the deal is higher, but the stock moved up. So you can see what the market thinks about this, and I would also like them to just walk away.
Yeah.
I mean, I would not see that as a failure, not at all. If you try to buy something and it doesn't, and it turns out that you cannot make a reasonable deal, just walk away. It's not a failure. I mean, failure would be if you let yourself be pushed into too high price and then pay something that you didn't really want to pay in the beginning. So I know that they tried to buy Carrefour 3 years ago, and the government said no one's going to touch Carrefour. They had to walk away. But that's not failure. I mean, that they just couldn't do it. They tried to buy a company in Australia during COVID, and they walked away. But correctly, I think this is discipline rather than failure. So I hope they don't do that.
Yeah, I mean, they have a history of doing large acquisition and being smart about this one. Big acquisition with leverage, and then
but they've never done anything above 10 billion.
Yeah, that's massive.
And this would be 40 billion. And I know that they're now the largest they've ever been, so they could do bigger and bigger transactions. But 40 billion is a lot.
That's massive. What's the rationale from management about the Japanese acquisition? Did they mention that synergies or potential market?
I think they haven't talked too much about it, but I think they could run the business much better. Because when I was in US in September, when I already knew that they're talking to 7-Eleven, I visited several 7-Eleven stores, and they look terrible. And I visited over last years. I visited a number of Couche-Tard stores, convenience stores and gas stations in various countries, and they look absolutely marvelous. So I think I think this is both an opportunity and risk. If they can buy 7-Eleven and bring the shops to their standards and raise the margins and efficiency to their standards, the acquired part of the business could perform much better. But at the same time, there's no guarantee that they could do that, because they would have to be working in different countries, etc. Also in Japan, the regulatory approval would take a long time. They would probably be required to divest some of the business, etc. So it would be kind of fluid, uncertain situation for some time. And I'm not very thrilled about that. I've seen too many large acquisitions being done by other companies, and most of them haven't worked out.
Yeah. Well, we will see. Time will tell. I don't know how long it takes for an acquisition to fail. Can they walk away like tomorrow, or does it take a few months so that we have the final conclusion on this story?
Oh, they can walk away anytime because they haven't made any commitment or anything. They can just say, okay, if you think you have a better buyer because we're gonna pay 50 billion, yeah, go ahead and do it, and we just walk away. They can do it at any time.
Yeah.
No strings attached. But if they going to do the transaction, it would be like 2 years of 2-year process before it's approved, done, settled, some parts divested. It would be a complicated situation. I like things that are easy, so
Yeah.
I hope them. I really want to see them go away.
Yeah, I mean, seems like a complex deal, and if the Japanese company doesn't want to be acquired, they can, I don't know, harm themselves before the acquisition, and I don't know. Usually, if they keep the management in place, when Alain Bouchard and their team from Couche-Tard acquire a company, do they keep the management or implement a new management from Canada? Because this is a different culture. Japanese guys.
This would be. This is a very large business, which has very many parts. So I don't know what they would do. I mean, until now they were doing friendly acquisitions, right? So they kept some management, and even Brian Hanash, who was CEO for 10 years until last quarter, also came through a company that was acquired. So he was actually retained and promoted. So they could do both, but I don't really know. They haven't said much about it yet.
Yeah. Speaking of stores, last week when you were in St. Louis with Chris Blomstrom, you shared a photo of William Sonoma's stores. Can you speak a little bit about William Sonoma and?
It's one of my favorite. One of my favorite positions, of our favorite positions. We've held the stock for a number of years, and they don't have shops in Europe. They have some in UK. So whenever I am in the States, I try to visit the store just to have a first an impression about the business. And their stores are absolutely fantastic. But when my wife comes with me to the store, she wants to buy everything. So I have to keep her away. But she wants to buy everything because the stores are. Last time we went to store in New York in Columbus Circle on the corner of the Central Park. And you walk in the store, it smells nice. So we said, why does it smell so nice? So we ask, and they actually put a special spices and fresh fruit in the oven and turn the oven on, and the whole shop smells nice. There's nice ambient music. Everything is clean. Everything is well organized. I mean, the stuff on the shelves is really beautiful. So it's the personnel is fantastic. I mean, it's really pleasant environment. You really feel like you want to buy everything. I'm not the big shopper, right? I don't really do much shopping at all. So I went to the shop only as a co-owner and with a professional interest. But I really appreciate this. These are one of the best stores I've ever visited. If you speak about retail, and that gives me a really good impression. Because sometimes, I mean, for example, when you go to some of the retail stores like Dollar General, or you go to Starbucks, especially disgusting, it's filthy, it's dirty. I mean, it's disorganized, I mean, but if you walk into William Sonoma, it really is good. But I know, of course, you don't buy stocks because you like the shop, but it tells something about the company, about the standards, about the environment, and I'm not surprised that they have such good margins and they have such high return on capital because they probably know what they're supposed to be doing.
Yeah, absolutely. And CEO Laura is quite driven, and the
Yeah.
strategy will not change for years.
Yeah, I hope so. I hope so.
Yeah. For all the companies you mentioned, they share some attributes being quality, good management, good capital allocation. For the viewers who wants to pick great stocks, I have two questions for you. First, where can you generate ideas if you are a retail investor, sophisticated investor, but retail? What is the best source of information? And second, what are the key attributes, key elements you look for so that you can screen for ideas and only go deep on the best ideas?
It's really hard to say. I don't really have one place where I would say, this is where I get the best ideas from. We get ideas from many places. When we started the fund, we got quite a few ideas from by doing screening, right? But we haven't really generated good investment idea from screening for many years. So then other ideas that we get from is when we follow some other fund managers. There's thousands of them. So what you want to do is you should select few of them that you like, not because of their results, but you like them because of their investment strategy and investment approach, and they also publish a lot about what they do, so you can actually learn about what they do and how they do it. So you follow their writings, their letters, their portfolios, not to copy them, not at all, that's a mistake, but to get an idea, things you should maybe look at. Then we get a lot of ideas by reading research of various kinds, not only from brokers, but from, other publishers. There's a lot of research being published on sites like Seeking Alpha or Value Investors Club, etc., and various publications. So that's always good source of ideas. General reading, basically, you read various things, read books, you read magazines, read trade magazines, you read websites, everything. And time to time, you just come across something and you say, okay, this might be a good idea. Let me look at that, and sometimes you think you realize that it's an interesting thing, Sometimes because we've been in the business for so many years, we have been following companies for now decades, in some cases. So what I would say, the old following, or is also a good source of ideas, because over time you tend to figure out that some types of businesses are good and some types of businesses are not good, and they don't change. I mean, bad businesses very rarely become good, and vice versa. So you distill your focus, to the most attractive part of the market, and if you keep following those companies, because prices change all the time to time, you get a good investment opportunity there. So I don't really have good tip where to find tips or ideas, but I think generally the more you're curious about things and the more you try to read it and educate yourself, the more chances there are that you come across a very good idea.
Yeah. And for the audience, there are many books about CEOs, companies. For Alimentation Couche-Tard, you have a book about Alain Bouchard.
Yeah.
You have it on this shelf. You have many other books, and if you are a curious person, you can follow big accounts on Twitter that may share some investment ideas.
Yep.
But reading other investors' letters are a great way to generate ideas. I mean, you talked before about BN, Brookfield. If I remember correctly, there are other investors that invested in Brookfield. You have Bill Ackman that made it his first position. A few days ago, we learned this. Josh Tarasoff, Tom Gaynor, Monish Pabrai at the time, 1 year ago. Who did you take this idea from? Who did you read?
It's a combination of following other fund managers and old following, because we have been shareholders of Markel Group for many years, right? And in Markel's equity portfolio, Brookfield has been always one of the largest positions, and at some, usually Berkshire is the largest, but for a while, even I think Brookfield was the biggest, and it's now in top 5. So we have always been following Brookfield because we were indirectly holding the shares through Markel, and for many years it was we couldn't figure out how to value the business because it has many different parts, and I wasn't sure, what value to ascribe to all of them, and etc. But they reorganized themselves about 2 years ago to much simpler structure, and all of a sudden, it occurred to us that there's actually quite an easy way to value the business, not precisely, but sufficiently precisely, and the stock was cheap, so we bought a large position, and yeah, so that's it. So it was a combination of following the stock for more than 10 years, and knowing that we indirectly own it through another fund manager.
Yeah, and the recent split in
And
BN
reasons,
and
yeah,
BAT.
yeah, and also we follow the others like KKR and Apollo and the Carlyle and Blackstone, etc. And I like the Brookfield most because it has the most favorable setup for the outside shareholders. Like meaning that the insiders have the least advantage over the outsiders in terms of the fees and money, etc. So I like that.
Yeah, I mean, if the audience wants to learn more about Brookfield, first you can read Vltava's letter that talks about Brookfield. I will put your website on the description below, and you can also watch 3 hours of content. The Brookfield annual meeting, you have investor conferences. This is 2 hours, 3 hours. You get a lot of information, and you see the clear strategy for the business. I mean,
they are obviously very bullish about the business. I mean, like every management, but the historical results are actually adequate to their bullishness. So and they're basically saying that the business is going to continue grow as it has been growing for the last 20 or 30 years. And they give you a lot of detailed information. They also tell you how they value the business themselves. I think it's too bullish, but nevertheless, it's a subjective opinion, and they own I don't know 20% of the business. The management and employees. So yeah, I think it's actually a business that will continue growing very fast for many years.
Yeah, in the latest quarters, as you said, the latest quarter or commentary from Bruce Flatt, the CEO, he said that they are big owners of the company. In the past 30 years, they have been growing 19% per year earnings, and they expect a brighter future. So very, very bullish actually from the management, the CEO himself.
Yeah. And they give you a lot of information, so you can make a different opinion, but you definitely cannot complain that you have little data. I mean, they publish a lot. They publish quarterly letters to investors. They publish extensive presentations. The investors' days are very detailed, and the quarterly reports are also very detailed. So the one was actually yesterday, I think. So it was very good. So I am pretty happy. About it.
And the CEO is buying share in the open market. If somebody wants to find a good entry point, just monitor when Bruce Flatt is buying more. You buy more. This is not financial advice, but I mean, if the CEO buys at the open market, given the culture, that's
selling shares to management usually has very, very, very small significance because there'll be many reasons why someone is selling shares, but there are only very few reasons why someone is buying shares for cash, right? So yeah, I agree.
Yeah. Okay, now let's change the topic and have this tricky question for you. What is the common mistake that you see for most investors right now? You see some short-term vision for the stock market. People don't read the financial statements. Given the current markets, what is the mistake that you see most of the time? And the follow-up question is, talk about one of your mistakes that you want to share with the audience so that people can learn from your experience. So first, mistake from the world. Second, your mistake.
If I can say, then I think most investors are probably too short-term oriented, and do very little fundamental research.
Okay.
Okay, and I think it can work for some time, but I don't think this is what investing is all about. So I consider that to be a wrong approach. But everyone can do that. And our mistake, I mean, the biggest mistakes that we've made and that I regret the most are cases where we made a very good investment. We made very good judgment. We were in minority, and we sold the stock too early. And our biggest mistake was selling Microsoft, because back in 2010, people hated Microsoft. Okay, it was still lower than in 2000, so it was 10 years in bear market. It traded at 10 times earnings. Okay, and people were saying, well, Microsoft is a business that is slowly going to die and disappear because no one's going to buy PCs anymore. So that was the crazy majority opinion in the market at that time.
Yes.
We disagreed, and we bought the shares at $22. Right, that was really 10 times earnings then. And for like a year or two, we had to several times explain to our own investors why we are buying a company that everyone knows is going to die soon, right? Luckily, the stock started to grow up, so they stopped asking these questions, and then the earnings started growing. So you had earnings growing, you had multiple expansion because the market started paying attention to Microsoft. But in our minds, we knew that we bought it at 10 times earnings. So when the stock, reached 15 and 17, we saw that's too expensive, and because, the stock was up maybe 3 times because the earnings were higher as well. And we sold the stock, but of course, now it's 20 times higher than where we bought it. And I don't think we would hold it today, because I don't think we would keep Microsoft at 35 times earnings. But I still think we left a lot of money on the table, where we had a correct opinion at a time where it was in minority. So it's a great setup. The market proved very soon that we were right, but we just didn't squeeze enough money out of this setup. We just sold it too early. So the lesson that we took from it is that in some cases, we should be more generous about the valuation. If things are working well, you just let them run longer than you would normally do, and most of the time, it would be a good decision.
That's also, as you said, making the difference between bad businesses that will stay bad and good businesses that will stay good. You want to stay in the great businesses, and it's okay if it has a little rich valuation. Great businesses will keep improving again and again and again. More revenue, more earnings, more cash flow, etc. Yeah, I see many big investors making this shift towards quality, buying stuff in the low PE ratios and then letting them grow. And it's about what you said about patience that people don't have in the market. It's very hard to just do nothing. If you held Amazon or Microsoft, you see the multiple expansion, you want to do something, you want to panic, you want to buy something else that is cheaper. The main difficulty in this market that is going up to the moon, we see some crazy behaviors, is to just do nothing and let the flowers grow.
Yeah.
Well, what has been your longest holding, by the way, in terms of years?
The longest holding is Berkshire now. I think we've held it for 13 years now, I think.
That's good. Congrats. That's great. And you plan to hold it even with Greg Abel as a CEO? Just wait and see.
I mean, the longer I watch, we talked about it when we were together in Omaha this year. I mean, the longer I watch Greg Abel, the more I like him. And I think he's already taken over a lot of responsibilities from Buffett. And when he takes the rest, I think he's going to be very good. He may have some advantages over Warren Buffett because he's actually runs some actual businesses, not only a financial conglomerate, which could be an advantage. So I think he would be ideal, and he could be in a place for another 15, 20 years because it's like early 60s. So I'm pretty happy. And Yeah, I mean, Berkshire is going to continue doing very well for many years. I think it's not now. It's not as cheap as it used to be during the last 10 years. It's now about 10% undervalued.
Mm.
But I think it's the only undervalued stock of the last 10 largest stocks in the US. I think everything else is overvalued, so it should still outperform the rest of the market.
Yeah. And will Greg Abel do some investment with the stock portfolio, or will it be only Ted and Todd doing the investments?
The way I understand it is that he will be in charge. He will be the top CEO in charge of everything.
Okay.
So I think he will make a decision regarding how much money is left for a public portfolio and how much is being invested in private businesses. But I don't think he would be doing the stock picking in the public part of the portfolio. I think it would be Todd and Ted. I think.
Okay, so bigger allocation because now they manage 15 billion, 20 billion each. Or
Yeah,
so.
maybe more. Well, you never know exactly, but it's probably more than that. But the whole size of the public portfolio is like 600 billion,
Immense.
and I mean, stock portfolio is now smaller than it used to be 6 months ago because they sold most of Apple, but it's still very large. I mean, Apple is now still largest position with about 70 billion.
Hmm.
The second largest is now American Express with something over 40 billion. So these are still large numbers. So that would be. I don't really know how. I mean, I wouldn't know how to run such a big portfolio. Right?
It's so huge.
It's very difficult, and I think very people realize how difficult actually job this is. So, and it's not going to get any easier. So what I think they should do is they should be much more aggressive in buying back shares, because the future of the business is not in the growth of the absolute size as much as in trying to grow size per share.
For sure.
Right?
Yeah.
Because if they have 600 billion portfolio now and 300 billion in cash today, I mean, they generate 40-50 billion every year. So 5 years from now, with some additional earnings, this could be, $1 trillion portfolio. So how are we going to invest $1 trillion of cash?
That's
No
too
way.
hard. That's too hard.
So yes, you can do large acquisitions, but the market is getting smaller and smaller. So one way of how to make this problem smaller is just to keep buying its own shares much more aggressively. So you would not have $1 trillion 5 years from now, but still it's only 600. But the number of shares in the circulation would be maybe 20% lower. I don't know what they could buy. So you can still. So per share, I think they would do very well in this case, and they would not have the problem of size as much as they will have now.
Yeah. I mean, we see right now their problem of size. If they want, I mean, the pool of opportunities is so small. We see them take some small position in Ulta, Domino's Pizza, but that's tiny position.
That's small. But I think, but markets will correct at one point a lot. I mean, they always go down 25% time to time. That 25% is not a big deal. And I strongly believe that at that times they will be very aggressive in buying back shares.
Oh, okay.
So, yeah.
Okay. Has Greg Abel talked about this? I mean, his intention as a CEO.
I think he would be overstepping Buffett's lines for the moment, because Buffett is still the key. But I think maybe part of the reason why Buffett is selling Apple is that he wants to sell it before Apple takes over. Because just imagine that Greg Abel takes over and they still own all of Apple, and then he starts selling Apple. So people would be saying, "Oh, so he just became CEO and he's already reversing Buffett's largest position." So what's going on? So if Buffett does it for him, right, he takes this problem away, and no one's going to criticize Buffett for selling Apple, when he's made more than 100 billion on it. So,
Yeah.
could be
Yeah.
reason, but I could be. This is just a speculation. Some people speculate that they might want to attempt to buy Chubb, which I would love, but
Oh, yeah.
and they will probably consume 120, 130 billion of cash, which I think would be great. But it's just a speculation.
Yeah. Just for the viewers, this is Chubb. The ticker symbol is CB. And
Yeah.
I mean, that's 100 billion. They have it. So that could
They
do the
own
work.
7% of it already. So
How much of it?
I think they own 7%.
Decent.
Chubb already. So they would buy. It's like 7 billion. So they would need to spend another 120, 130 billion to buy it, and that would be fantastic, I think.
Yeah. What was the size of Allegheny at the time?
I mean, the acquisition price was only about something like 11 billion.
Oh, not big
So
compared
much
to
smaller.
much.
Chubb is much bigger business, and it is insurance business, which I understand. It has it doesn't overlap that much with Berkshire Insurance because it does a lot of international insurance, which Berkshire does mostly domestic. So that's additional, and it would also bring a very large float to Berkshire. So they actually might end up with more cash to invest after the acquisition than before the acquisition.
Almost the same problem.
And it would perfectly fit. And it would also bring talent because it's the younger Greenberg that's running Chubb, and he's very good. And they could always use good talent in the insurance business because Ajit Jan is also not getting any younger, and unfortunately, his days are not numbered, but his tenure is also getting close to the end.
He's what in his 70s, 80s.
Yeah.
How old is Ajit Jain?
70s, I think.
70s. Okay.
Yeah.
Yeah. He wants to be a younger guy. Oh, they will perform strongly.
73. Ajit Jan is 73.
73.
Yeah. So he can still be doing for another 10 years.
Yeah, that's decent.
But they could always if they can bring someone who is 50, okay, and even if Ajit stays for another 10 years, they would benefit tremendously from working together. So there's if you can acquire good people with a good business together, that's very good, especially insurance, which is basically people's business.
Yeah. They know how it works. They've been doing this. They are maybe the most expert guys about insurance. That would be a good fit, I think. But the main reason why Berkshire has sold Apple, and I think everybody agrees, is the lack of opportunities at the moment, given the stretched valuation. So it's not the first time. But after this, it is pure speculation.
The thing is that the dominance of passive investing means that the largest companies have become the most expensive. That's the nature of passive investing, because the feedback that works is having this effect. So the best opportunities are in mid caps and small caps, which are too small for Berkshire to be meaningless. So they unfortunately, their playground is among the most expensive stocks. So that's why they find it difficult to find opportunities. I find it very easy because I don't need to buy. I don't need to put 20 billion in something to make. I can put 20 million or 2 million and it still makes sense. So small investors and individual investors have a huge advantage over Warren Buffett because they have much bigger playground and many more opportunities available.
Yeah. Even if somebody watches this channel wants to get inspired, you see Warren Buffett buying some Japanese equities at the time in 2020. Somebody could do the work, pink sheets, small caps in Japan. And
but he didn't buy small stuff. He bought the largest trading companies, which are known to everybody. And
did you see the results?
He was buying them at like 5 times earnings. So
yeah.
I mean, people don't have any excuse if they didn't know about them or didn't find them. It was only their mistake because they were available to everybody, and everyone could do them.
Yeah. I mean, I tried to reverse engineer his thinking with the data he had at the time. I didn't see the opportunity. So, but people that is more somebody that is more knowledgeable about Japanese conglomerate, exchange, import, export stuff, commerce, could see the opportunity. And the returns are fabulous. I don't know if it is a 3x or 4x.
I think he maybe tripled the money already. Yeah.
Incredible. With cheap debt, like 0 yen
He
debt.
financed it to a large extent by borrowing in Japanese yen, long term, where he's paying maybe around 1% on average, right? And only the dividend yield on these stocks are 5 times bigger, maybe even more than that. So basically,
Free money.
there's no currency risk, and the thing pays for itself.
Yeah, that's right.
And the thing is that it didn't require any special sophistication or any advanced knowledge. It was really, really simple idea, but you just have to be willing to do the work and look for them.
Yeah. I mean, I don't know if people actually can take a loan in yen. I don't even know if you have to open a bank account in Japan to do this kind of stuff.
No, you can buy. I mean, we buy Japanese stocks, and we can buy Japanese stocks, and pretty much every broker can do that. So it's the second largest market in the world. It's not buying stuff in Nigeria, right? No, it's very, very, very easy. And currency yen, it's extremely liquid, so it's actually a very, very easy market to trade. There's no restrictions basically there are restrictions, but if you just want to do ordinary investments, you can do that very, very easily. I mean, countries like India, for example, are much more difficult to access for individual investors, but Japan is very simple.
Yeah. No, for the stock buying, you have brokers that allow you to buy in Japan. But for the borrowing part, if you want to borrow, I don't know if.
Well, he issued bonds in Japanese yen, of course, but I mean, individual investors will not be issuing bonds in Japanese yen, but you can. I mean, if you use interactive brokers, you can borrow yen very easily. I mean, they charge you very little because the interest rates are close to zero still. So I don't really recommend people to borrow money to buy stocks, but it is possible.
Yeah. Okay, interesting. I will look into it. Not to do it, but to know how it works. Okay, well, do you have any last point that you want to share to?
No, it's been a pleasure. As you know, I like chatting about stocks with you too. So yeah, it's been a pleasure.
Yeah, thank you for coming. Where should people go to learn more about your fund, Vltava fund? I will put the website in the description.
Put the website. It's bilingual, so everything that we put, almost everything is in English as well. And yeah, I've written a book now, which will be published in January here in Czech language.
Good.
And it's now also being translated into English. So my intention is also to publish it next year in English, so then they can also read about it, about what we do more.
What's the pitch of the book? That's business stories.
It's quite unique because I've read almost everything that was ever written about investing, and I can't remember of any other book that will be written in this format. So it basically consists only of individual case, 15 individual stocks that are described, and we own all of them today. So it's not like I would select something that 5 years ago was cheap and they create the investment story about it, just why you should buy it 5 years ago. No, it's all the stocks that we own today. And I'm trying to show people in how many places, in how many ways you can find value in the markets today. And to every case study, I try to attach more general investment topic that is applicable, over time and to our investments as well. So it's very specific and also very actual because it's basing the investment approach on the fact that so few people are looking for undervalued stocks today, which is fantastic. That's what you want.
Yep, absolutely. For stock pickers, I mean, this is one of the best books you can find. Real stories with stocks that are on the portfolio. So what can you wish for?
It's like imagine you going to run a New York Marathon. Okay, so we got 40,000 runners, and then before the start, they ask everybody, who wants to win the race and who doesn't want to win the race. And like 90% of people say, oh, we don't want to win the race. We don't really care. So, you know, that's the same about investments today. I mean, so many people have given up on trying to
Do the work.
do the work. So competition is quite weak. It hasn't been so weak in stock picking, as long as I remember.
Yeah. Just as a quick question for the end, we see a lot of craziness right now with the Dogecoin, Bitcoin stuff that is looking more or less like 2021. My opinion is we are not that crazy compared to 2021. We have some steps to go. What is your opinion on this one? Do you see the same craziness that happened in 2021?
Yeah, in some cases, yes, but also in individual stocks. But I just don't pay any attention to that. You don't have to participate in things that are crazy.
Oh yeah, well, I suppose you won't participate in Dogecoin.
No,
That's
no,
an easy
no.
path.
I leave it. I fully focused on stocks.
Yeah. Okay. Well, thank you for your time. It was very helpful for the audience. Please comment below if you need any more information. But I will put your link in the description. I will put your website, and yeah, if you have any question, don't hesitate to comment to the video. Goodbye.
Yeah. Thank you for the invitation, and good luck, Christopher, to what you do. I've been following your videos, and I enjoyed them.
Yeah. Thank you very much.
Okay. Cheers and take care. Bye-bye.
Bye-bye.
If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.